Hi, everyone, and welcome to SummerSaaS 2023, organized and run by Flashpoint. We're very excited and glad to have you here with us today for the third consecutive year. We are organizing this event and very happy that we managed to gather so many people here today. First of all, I would like to thank a number of people who made this event happen. I would like to thank, first of all, our sponsor for the pitch competition, SaaS Stock. Thank you guys for participating and helping us to organize the competition. I would like to thank Dealroom, our general data provider. I would also like to thank numerous venture capital firms, private equity firms, and other organizations who have come to participate and join us during the day-to-day. There are literally dozens of organizations who are participating. We're super excited that this becomes a true ecosystem event. I would love to thank multiple and numerous entrepreneurs and startups who have decided to join us and participate in the pitch competition. There were a number of them, and whoever wins in the end is going to have a well-deserved prize. The others will get a very important experience. So thank you guys for participating, and also thanks to multiple audience who have registered today to listen to the content, valuable content presentations, and also listen to the pitch competition. And lastly, I would like to thank Flashpoint team. A number of people involved in organizing this event. From my heart, I'm so glad and happy that we managed to pull this together again. Thanks a lot for all your efforts, passion, and sleepless nights. Thank you guys. With this, I would like to maybe commence with my short presentation. First, wanted to introduce briefly the agenda for today. We're going to have two tracks. One is the stage, where we're going to have a number of presentations. Dealroom will talk about the market environment. We will talk about a number of topics, including corporate venture capital, including various forms of debt raising. We'll talk about liquidity options for minority shareholders. We'll also talk about some ecosystem topics around scouting for projects. The second track will include 5 pitch sessions, ending with the final, where the jury will be listening to the winners of each session. So we hope that you enjoy every part of our agenda. A lot of thought and process has been put into organizing this. So hope you enjoy our event. Wanted to also say a couple of words about Flashpoint. Just to remind everyone, we are an international asset management firm. We are focusing on supporting B2B software companies that are originating out of Eastern Europe and Israel, but working across the globe and also as part of it in Western markets. We offer 3 strategies. We are an early stage VC investor, supporting companies from post-seed Series A stage and onwards. We also offer debt product for later stage companies, and also we have a solution for offering liquidity to minority shareholders and management of later stage companies who are looking to capitalize and monetize their equity. We're a team of about 30 people. We have among founders have known each other for more than 20 years, and we have been on operation since 2012. We have 5 funds running right now across our products. We're also supported by EU sovereign institutional capital as part of our funds. We're quite excited to have our great investors on board. We have done over 60 transactions over our lifetime. A lot of follow-ons, a number of exits to various buyers, strategic private equity. We have certain approach to finding companies and scoring them, analyzing them. People who have interacted with us know us for our data-driven approach. We are looking at about 2,000 companies a year, and we're very happy to partner with a number of select few who become our partners for a very long time. It's like building a family relationship. And we're very active in our portfolio involvement. We help and try to be value add to the founders, companies, and our other stakeholders and partners within the companies, taking a very consensus-driven and collective approach to pushing the company towards success. We have about 140 investors. Some of them will be present here today listening. We're happy for you guys to be part of this as well. You have been investing with us for a long time now. Some of you longer, some of you less so, but hope you are enjoying it as much as we do. And also our team as a general partner, we are a large investor in Flashpoint products since we started early days and kept rolling the capital. As I mentioned, we have basically several strategies. In venture capital, we are focusing on companies at product market fit stage, when you start making your revenue and you would like to scale your product, but also scale your R&D. We've done about 50 investments there. Growth debt is more applicable for companies starting from about 300, 500K MRR, with already having done Series A or maybe even Series B. We have done a dozen of investments there. Secondary companies with revenues from 10 to 20 million. So these are already more mature growth technology businesses. We have now done almost 10 transactions there as well. Wanted to talk a little bit about a number of things that are sort of keeping us sleepless at night, which we think are also important for the founders and entrepreneurs. As you know, the last 18 months basically have been quite volatile in terms of macroeconomic activity, geopolitical tensions, and that all impacted our own market, our niche, because less deals are being made. The valuations have been changing significantly. At the early stages, you can see the valuations have been less impacted. I think our colleague Luis from Deal Room will talk in more detail about the dynamics there, but we see a lot of volatility. At the later stage, the volatility has been even more so. And as you grow your company, obviously you have to be aware about this and conscious that the valuation might not be $1 billion valuation as you targeted before. There is a lot of pressure on the companies as they grow and build the businesses. And in that sense, with all the volatility and the changing market environment, what we're seeing from later stage investors, but also what we're trying to talk to founders about, is the increased importance of your KPIs, your metrics that you're targeting. So the underlying business fundamentals are becoming even more so important. Not only your growth at all cost, or sometimes just growth is important for people. Not only your target valuation and your ambition, but also how you're building the company also becomes quite important. So that's what I wanted to make a short presentation about today to kick off our conference. First part, which I wanted to focus on, revenue metrics. Obviously, revenue quality is something that could differ between companies depending on which segment and sector you're in. There is recurring revenue and there is one-off revenue. So obviously, the importance of recurring revenue is high, and we would want to see companies targeting at least 80% of recurring revenue. Then there is product revenue coming from your main product and operations and service revenue. A lot of companies charge various types of service fees, commissions, etc. So product is much more important, and that's where you should be focusing on. Revenue growth has been a theme of the last almost decade. Companies have been targeting growth, trying to achieve as much as possible. But today we see that growth should be balanced. With how much you're spending, with your cash flow. And as money has become a more restricted asset, it's not as easy to raise capital anymore. I think the importance of cash flow and efficiency is gaining priority. Revenue source, also there could be new customers or existing customers expanding or contracting. So for us and for any investor, both of these metrics would be quite important, because if you're adding only new customers but you are not capable to expand your existing customer revenue, it might be hurting you down the road. So developing product and focusing on product, working with your customers is quite important. So that part should be also taken into account. Revenue accounting, another part here, which is also, I think, is interesting. We see startups come to us with various types of metrics: contracted ARR, just MRR, cash MRR, and not many people at the early stage sort of differentiate between that and think that the higher the number, the better it is for your marketing purposes. But more sophisticated investors and investors who are looking to invest in you at later stages obviously will focus on your actual MRR or your accrual MRR. Obviously, costs should be aligned to that, and that's how we also will be looking at things. Contracted MRR is helpful, gives you a sort of forecast of where you're going to be in the coming months. So it's a helpful metric. Cash MRR, also cash collections, depending on which segment you're in, but sometimes becomes an issue. So that metric is worth following, but the accrual MRR is the one to focus on. Revenue concentration, as you're early stage, you might sometimes have a situation where you have one substantial customer or two customers that are dominating your revenue composition. That obviously creates a risk, creates pressure on your ability to raise money. So obviously, it's important to try and diversify. The metric here is roughly 20% of clients should be not more than 40% of your revenue. Otherwise, it becomes more of a risky profile than investors would want to see. Contract length with your customers. Basically, especially in current environment, customers are dictating the terms more. You need to fight for your customers, but if you could win contracts that are of longer length, that is always a preference. We discuss a lot pricing versus contract length, discounts, etc. So in the current environment, we think that having a more committed customers is important. Obviously, churn is viewed negatively. So from that sense, having multi-year contracts is quite important. The other metric here is ARPA that we are monitoring, is your annual run rate revenue divided by your customers. Obviously, people will want to see how much new ARPA you're gaining, how much ARPA you're losing, but also the trend on this nice chart shows that ARPA is growing, which is quite encouraging and exciting, in your product development shows results and people are paying more for your product. Also, you're becoming better probably at selling at higher prices. The other, having finished with the revenue, the other part to discuss is gross margin. At times, people underestimate the importance of that. Obviously, gross margin is revenue less COGS divided by revenues. So for different business models, this metric could be different. For software as a service companies, the target is around 80%. Some companies might have lower, some companies might have higher. Obviously, the higher it is, the better it is for you. It shows the longer term capability to achieve profitability and cash flow. So for marketplace businesses or B2C companies, gross margins could be much lower, down to 20-30%, which puts pressure on their ability to turn profitable. It requires, probably much larger scale, and that would be sort of in the current markets. These companies are valued much lower on a multiple basis. So gross margin is quite important. And then also to talk about sort of customer side of things and cost side of things. Retention is something that we care a lot about. The percent of customers that you are keeping. 80% logo retention is a metric that we sort of would be targeting in B2B software companies. Obviously, churn is unavoidable. Everyone loses customers. There is nothing it's not the end of the world. You need to understand the nature of your churn, the reasons for your churn, but targeting higher retention is quite important because otherwise you don't want to turn your your go-to-market strategy. You cannot have too much leakage out of it. You put too much effort and money into that. So having high churn could be detrimental. In SMB businesses, churn could be lower. SMB focused segments could be down to maybe 6%, 60%, which makes them more. It makes it more difficult for them to get to higher net dollar retention numbers, which we're going to talk a little bit about in a minute. So revenue or dollar retention shows basically how much money have you been able to retain from your cohorts over time. We focus on gross dollar retention without expansion, and we focus on net dollar retention. Best companies have over 130% net dollar retention, which is currently which is an impressive figure to target. In general, if you have net dollar retention over 100%, it shows that your business model is healthy and you can continue growing without adding too much new sales, and adds more sustainability to your company. And then also the other part of metrics is unit economics. I won't bore you too much with that. Everyone has heard the word CAC, all your sales and marketing plus customer care costs. I think the only nuance that I would mention here is that we also add salaries of sort of department managers in here. Top managers could potentially be excluded, being like part of the fixed cost, but the variable costs we definitely want to be adding here to have a more like realistic picture of your business performance. And then the other metric that goes alongside is lifetime value. There are several ways of looking at it. The basic approximation is looking at your ARPA multiplied by your gross margin, giving you headline profitability of your business divided by the logo churn in the period. So that will give you a rough estimation of where your lifetime value is. We would like to, we ourselves will look at cohort-based LTV, which gives a much better picture of your LTV. We are calculating the essentially the coefficient on the basis of your cohorts. That allows us to use it as a cohort multiplication factor to basically calculate a more precise view of your lifetime value looking at cohorts. And the difference could be quite substantial. So in our case, on the basically without looking at cohorts, your LTV could get, let's say in our example, to $34,000 if you have ARPA of 10. Margin of 85 and basically your logo churn of 25. Looking at cohorts with the same sort of inputs, you could have a higher LTV. So it's worth digging into it a bit better and deeper. Cohorts show basically a more precise picture of where your customers are. And then we calculate LTV to CAC, which basically allows us to see how much cushion do you have in your go-to-market strategy to scale. A lot of times we hear founders saying, oh, as I grow, my CAC will decrease. But coming from smaller scale and earlier stages, it's not always working as an assumption. Not all the time your CAC will be decreasing as you are adding more customers. The marginal cost of addition of that revenue could actually be higher. We're targeting anywhere 3 to 5 times LTV to CAC. The more the better, obviously. The other part which I wanted to briefly cover is efficiency metrics, revenue per employee. We all read the research report by A16Z. So for the top 10%, they're saying that ARR per FTE should be around $167,000. So if you are at 2 million ARR, it means that you should have about basically 15 people in your company. So that shows you how efficient you are in terms of your revenue. ARR to cash raise, some people also look at that multiple. Basically, the closer, the bigger it is, the better. So the more you can achieve with a smaller amount of capital employed is better. The other important metric that people started focusing on is magic number. So new ARR in the period versus how much money you spent on sales and marketing. So the magic number of 0.75 is a metric that a lot of investors are targeting, or better, in their analysis. So worth keeping in mind. And the other one is the sales efficiency. So CAC payback, basically implying and showing how many months is it gonna take to recoup your customer acquisition cost. Under a year is a good metric. Obviously, it depends if you're an enterprise or SMB. It could be a different metric, but in general, less than a year is a good target. Rule of 40, another important one, which shows basically how much burn versus growth you are showing. So if you are burning, let's say, same amount as your revenue, so your cash flow is minus 100%, your cash flow margin. So which means that to perform the rule of 40, you must be growing more than 140% to maintain that growth. So this is a good metric to basically try and balance your burn versus your growth. So if you're growing less than that, you need to be cutting down on burn. Otherwise, the rule of 40 will not work and makes your company less attractive from that perspective. And then obviously the burn multiple, so how much you burn versus your net new ARR. 10% of companies that are better performing on the A16Z survey had their burn multiple less than 0.45. So the closer it is to zero, obviously, the better it is. But something also worth including in your metrics and your targets. That's it with my part of the presentation. I hope you enjoyed it. Sorry for being maybe like brief at times. Happy to, if you have any more questions on any of the topics or the importance of any of the metrics, we're always at your disposal and we'll be happy to answer your questions or give you guidance. So please feel free to ping us.